Welcome back. A happy new year to you all. Hope your holiday season was restful. You got the time to spend with your family and reconnected, kindled, and you're forwarding into the new year with a fresh mindset, more positive mindset, and with clearer goals and objectives. Today I wanted to go over price reversals and how you can anticipate those with confidence, avoiding the false breakouts and um, just being on the right side of the market. So I did some sketching here, which I hope will be able to assist with my explanation of what I'm trying to say. So you'd have heard me speak about SMT before. I would have done a couple of videos that would have gone through that and how to use it, how to anticipate it, and so on. I'm using this example, could have been any asset really. Remember that when we're looking for sequential, when we're looking for smart money reversals, then we are looking at key levels of price from which price will shift. So key levels would refer to your fair value gaps, your highs and lows, and any other imbalance, whether it's a volume imbalance or can be a balanced price range, whatever the case is, that is a key level on a higher time frame. So higher time frame, we are speaking of the weekly, daily, for all 1 hour time frames, even down to the 15-minute time frame, depending on the type of trader you are, whether you scalp, intraday, intra-week, or you swing trade. So if we're using, for example, the days of the week, so we're looking at the weekly profile and we are looking to catch the weekly range. So the diagram here shows that we have Monday, so each leg is a day. So that's Monday, Tuesday, Wednesday, Thursday, and then Friday. All right, quite simple. So Monday sets the high and the low of the week. We know that this is the initial balance, and this gives us our range for the week. We're not going to be looking into the previous week and so on. At this point in time, we're just going to be looking at the days. So Monday sets that high and low. Unless there's a high impact news event in here or you see some great confirmation for a scalp, then we leave Monday alone. We allow Monday to play out and print its price action and tell us what it's doing. Tuesday comes. Tuesday basically is an inside day. We have there are no highs or lows broken, and price continues higher. This is assuming that we're in a bullish scenario. Wednesday, we set the high of the week and trade lower, taking the lows of Monday and Tuesday. Thursday, we set the low of the week and expand. Wednesday sets the high of the week, Thursday sets the low of the week, and Friday comes back and takes that high. So Friday ends up being the high of the week. All right, so in terms of what we are looking for and what criteria we need for us to be even looking for a trade, we want to be trading on the days where we have high impact news events. That's what the HINE means. Those are news drivers that help to propel price towards our targets even faster and with more confidence, right? So there's no meandering sideways movement. Once you catch the move, you anticipate the move, catch the move, your trade is going to be getting to its target quite quickly. and the expansion will be larger. Right? So we want that kind of price environment to be trading in. We don't want to be guessing as to whether or not what we're doing is correct. So if we look carefully now, this is Monday's low. We have Tuesday's low. This is gold. We come here, we have silver. So Monday sets that low and high. Tuesday comes on silver and takes that low. We have a divergence here. This now would have told us that we are to pay attention, because once price trades below this low but fails to do the same thing here in the correlating asset, that's our signal to pay attention. If we're trading gold in the New York session, for example, then we're going to be waiting for that high impact news driver to pass, give us confirmations in terms of, so for example, say this is the 15-minute time frame showing us the days of the week. On the 15-minute, we trade below Monday's low. We fail to do so here. Once we're going to be looking for our confirmations in here, meaning we already have SMT on the higher time frame. So this could have been the 1 hour or the 15-minute time frame. We're now looking for further confirmation on the 5-minute or 1-minute time frame. So we're either going to be looking for a breaking structure, or we're going to, after the breaking structure, wait for price to trade back into a fair value gap or balanced price range or inverted fair value gap, whatever it is that you use to confirm your trades. We do it a little bit differently, where we look for what we call these snowflakes, right? That's just a very playful name for what we use. That would have come right inside of the swing point, inside of the SMT, and we would be able to enter quite early to the trade and catch that back to the high of Monday. Could have even been back to the high of the previous week in this case, and we're most likely trading gold. So Wednesday comes, gives us another setup. We're at the high of the week, and if it is that we took the previous week's high, then we know that we can look for sells. What would confirm this? We'd want to see SMT in here if we don't see it here. And we'd want to have that news driver as well, high impact news. On Thursday, we see something similar where price trades below Monday and Tuesday's low on gold, but on silver, it fails to do the same. That's our cracking correlation or a divergence. This is our signal to look for an entry. We use the same criteria. We want to be trading below the open of the day. We want to be trading below, we want to be trading in discount. So we want to be buying in discount, selling in premium. So in this case, we're buying. We're looking for confirmations in the swing, or we wait for the breaking structure and the other confirmations that you may need to see and take that trade back to the high of it. All right, so in terms of confirming, having your confirmations, the SMT is the most powerful thing you can use to anticipate reversals in price action, right? Any cracking correlation that you see. So say, for example, we are trading the sessions. We want to have our higher time frame bias in mind. We don't necessarily always need that, because the SMT will tell you where price is going. But if it is that you want to have some narrative other than just this, then it's a higher time frame bias, right? So in this example, Asia consolidates as usual. We get manipulation in London. New York comes, takes London's low here. What we'd want to see on the correlating asset is that New York fails to take the London low, even though London would have already taken Asia. So we'd want to see a failure swing on the correlating asset to confirm the move upwards. Otherwise, it could be a trap and it could be a breakout and continuation. So Asia consolidates, look for the manipulation in London and look for that confirming element inside of New York to take price back to the high of the day. Asia expands, and for example, London consolidates, we'd want to see further expansion in New York, giving us some form of manipulation happening, and we want to see SMT happening again at that high of day. So this was the low of day at the high of the day. Want to see SMT being created here. So some failure swing on one asset while the other does the turtle soup. And inside of that second leg of the SMT, we want to see a confirmation for entry and for the sell back to the low of the day. So these are how you can catch the weekly range or the daily range. SMT will confirm that reversal. And if you go back in your charts and really backtest and study it, you'll see that SMT is there 100% of the times, or that snowflake element that we have that will tell us that price will reverse, which is guaranteed. I know I'm beating my chest, but based on my experience, it is guaranteed. But you want to see the SMT happening at key level. So whether at the high of the day, the high of the week, the high of session, I'm just saying high could be lower high. You want to see it inside of internal range liquidity. So either internal range liquidity such as the imbalances, or at external range liquidity where you have highs and lows. And you will have old highs and old lows, right? So once you have SMT forming at those levels, it is more likely that it will play out. So just look for your key levels, wait for the high impact news events. That's your timing element. You want to be trading in line with what the news event is showing. So you allow that to play out and then look for your entry. This is important. This is your timing element. Your session also adds to your timing element, depending on where that high impact news event falls. SMT builds it, confirms the narrative. Our snowflakes inside of our mentorship, we know about what these are for. You want to be selling in premium and buying in discount using the true opens to tell you where you are. So there are dynamic support and resistance as well as dynamic premium and discount pages. So if you're going to be buying, you want to be buying below the day, which is midnight, sorry. And if you're selling, you want to be selling above that. So you'll find that price will align itself when the time is right. And you want to have that higher time frame bias if it is that you're not comfortable with this trading either the session or using the SMT as the only confirmation aside from your other confirming elements that you may use. So let's fetch price action. So we had 17. So SMT would have printed smooth here. We would have had what's happening? Right. So as I look, I see my snowflake, and my snowflake forms right in the swing point here. And once that snowflake closes, I'm looking for an entry either in the open or the close of the candle, depending on what type of candle it closes as. Trading back to these highs and possibly a pullback to continue. Although we do have SMT at these highs now, which could mean that price could come back and take this close, right? Because gold has bearish. We do have a confirming element here. So when the market opens later on, I'll see what happens. So show you. terms of what I was referring to with the previous day's high and low. So Friday, all of this price action is Friday. This is so Monday would have started, that price action would have started here. So let's just use some vertical lines to divide price action. That's Tuesday. Right, so look at too far. So this is exactly what I'm speaking about. So Monday sets that range. Tuesday fails to take the low here. Wednesday on silver takes that low. So this is Monday's low here. So this is Tuesday. Tuesday takes a low. And while on platinum, we have similar price action. So we have that SMT happening here as well. Right? So look for Monday was taken. Right. So if we even look further, so all right, let's not jump the gun. So Tuesday opens, price ranges, London takes Asia's low, gives us that push into New York. New York comes back, fills the gap, and then gives us a continuation higher. That's what I was just referring to just now. It's just by coincidence that it's a similar price action that is playing out here. So if you remember ICT's weekly profile where Monday or Tuesday can give us that classic expansion for the week, this is that kind of weekly profile that we're seeing here. And Friday gives us a reversal. So Monday sets a low, Tuesday expands, Wednesday expands, Thursday expands, and it we get the classic Monday classic expansion week. So that's what happened here. There was no SMT in here to tell us that there was going to be any reversal. We had continuation, right? So without that, we are not looking for anything if it is that we're trading just reversals, right? So I hope you're seeing what I'm saying even more clearly. And see if we can find another example. There's a exchange close. Separate that. So Monday, Tuesday, Wednesday. So it's correct. All right, so Monday, Tuesday, Wednesday, Thursday. This is Friday. Thursday, Tuesday, Wednesday, Thursday. I knew something was off. All right, so unless it is a holiday, it is a holiday, right? Which is a time when we really wouldn't be trading anyway. So, but so there's gonna be some time distortion in this. I'm wondering if I even should use this example. Up one, so 26, the 25th, 25th had a partial day on the 25th. That's why that is out. Let's change. Let's not use that. All right. So let's use this week. All right. That's the week open. Let's just change the colors again. maybe a green. Now, okay. So Monday, Tuesday, Wednesday, Thursday, Friday. Great. So Monday sets that range for the week. So that high and low for the week. Tuesday comes, trades down. Uh, there, if we look at the other, so this is Monday, Tuesday, Wednesday, etc. So it comes, Tuesday continues downwards. Wednesday, let's watch all three assets carefully. I think I need to just drop the lines so on so that I'm not seeing anything. Same thing here. Products. Okay. Okay. So if we're watching all three assets, this is so on platinum, price action was a bit different, meaning we didn't have that consolidation on the Monday. We had an expansion, which is not a bad thing. We want to see something different happening among the three assets. That's what gives us the cracking correlation. Tuesday comes, all three assets failed to take Monday's high. So that's Tuesday's high. Didn't take Monday's low either here, but on the other two assets, it took the low. Considering the time of year, though, price action is not going to be high probability at all times. Different things can happen. We did have that SMT though, which is what created this move on. Right. So this was a failure swing. So let's see. This would have been the close of Tuesday. Tuesday closed high actually, and then so there still was no higher low taken here. So yes, we had a failure swing with the between Tuesday and Monday. But that price action played out same day in terms of where price is going at the end of the day. All right, so Wednesday opens. Wednesday is still inside of the range of the week. And this is Wednesday, still trading sideways basically on gold and silver. So we had this huge drop, huge drop. Let's see what would have caused that. Right, I think I saw what caused that. Right, so Wednesday traded above Tuesday's high, failed to do so here, and it failed to do so here. Right, so that's our cracking correlation or divergence or SMT. This is in London. London would have given us the first move, and then New York would have continued that move down. All right, so we are at Thursday. Thursday continues the move, and we're at the low of the week. And let's see what happens. All of this was Wednesday, actually. We're now on Thursday. Thursday on silver takes the low of Wednesday. On gold, it failed, and on platinum, it failed. Coming to Friday, that would have been our signal to look for buys on Friday, right? Based on how price closed on Thursday. We have Friday expanding back inside the range. which is no surprise after the SMT that was here. All right, so that's how you look at it. Let's use the key levels, the highs and lows, the imbalances. Let me see if I can find an example with the imbalance to show you, for example. Let's use a 4-hour. So we're going from internal range to external range liquidity. Joints. It's not. Anyhow, okay. Great. So let us see what we can find. So we have, this is an example. This gap on the 4-hour time frame. Price traded into it. And same gap here. And also look for cracks in correlation using imbalances as well. Is that the same gap? Yep. There was no gap formed. Well, the gap is dull. There's no gap formed. The gap was formed in a different candle on platinum. So let us use both silver and gold. So gold created a low inside the gap. That low on silver went a little bit higher, while this was a sweep. Obviously, you would have to look for entries and confirmations on the lower time frame, and target would have been the high right there. So this is how you can use the imbalances. You look for the SMT inside of the imbalance and use the confirming elements to help you to take the trade. Similar here. You can look for a cracking correlation. Let's see if we see any. Same price action, same time fair value gap. Same thing here. Fair value gap formed at the same time. You want to be matching the time across assets, because that's where you're going to see the cracking correlation. All right, so if we notice, price on the 6 o'clock candle traded back into the fair value gap on gold and on platinum, while on silver it failed to reach back into here. So that's the cracking correlation. Also, once you see that happening where price is already in here, price isn't even attempting to go here, you can look for your entry inside of the gap from a lower time frame. Let's go to the 15-minute time frame and see. See what you're seeing. So remember, we're using the open and the close, the bodies of the candles that traded higher. This failed, and this also failed. That's your SMT inside of the imbalance. And of course, we had this failure swing, and that's our confirmation to sell. Let's see if I would have seen my snowflake, and that's my snowflake, and I would have entered right after the close of this candle. That's a sell. So the move never really misses. We're never late for the move. Right. So I hope this was useful, something you can work on to help you with your trading for this year. And of course, if you have any questions or any thoughts, you can always put them in the comments. I'm always active and always replying. And of course, it would be nice to get some likes and shares and just support this video and the effort. Right. Hope you have a good week coming, and all the best for the rest of the new year. Thanks for watching, and take care. Bye-bye.